will the Fed fire up money printers again? It's a question everyone's asking, and the answer could shake the global markets. Because if Fed does return to loose monetary policy, risky assets such as Bitcoin might not just benefit, it could explode. In this video, we are breaking down exactly what Fed liquidity means, why it matters now more than ever before, and how it could supercharge Bitcoin's next big move. So let's get into it. So the question is, will the Fed print money again? And the short answer is yes, but not in the same way it did in 2020 or 2021. But some form of liquidity expansion or stimulus is very likely on the table, especially if economic conditions worsen. In the first segment of this video, I will be looking deeper into some of the most important questions investors are asking right now. What would make the Fed fire up the presses again? What does money printing actually mean today? And what are the current signals from the Fed as in April 2025? So here's the full picture. What would make the Fed fire up presses again? Three things could trigger the presses: recession or growth shock, debt market instability, and the systemic risk. Now, if economic data turns sharply negative, say job losses spike or consumer spending collapses, the Fed could step in with stimulus. Then we have over $34 trillion in US debt. Any dysfunction in the treasury markets could force the Fed to step in as a buyer of last resort again. And the third trigger could be any major bank failure or a global event. Think along the lines of Credit Suisse or Lehman style moment would almost guarantee that the Fed starts liquidity support again. But what does money printing actually mean today? The term money printing typically refers to quantitative easing or QE, where the Fed buys bonds to inject cash into the financial system. Money printing also means lowering interest rates. That makes borrowing cheaper, encouraging spending and investment. And money printing could also look like crisis lending facilities, just like back in 2020 during the COVID times, where the Fed offered direct liquidity to stabilize the markets. But today, with inflation still a higher concern, the Fed is walking a tightrope because there is a trap. The trap of inflation versus liquidity. Now, if the Fed turns dovish too quickly, inflation could spike again, the dollar could weaken, and asset bubbles, especially in the crypto, real estate, and equities, could expand. If they stay tight too long, credit dries up, recession risks keep climbing, and the debt burden becomes harder and harder to manage. So what's the likely move? This takes us to the next question, which is, what are the current signals from the Fed? Are there any current signals from the Fed as in April 2025? First signal is that the Fed has paused rate hikes but hasn't cut aggressively yet. The second signal that I can see is market watchers are pricing in a potential rate cut cycle by late 2025 if economic data softens. And the third signal that I can see is the Fed is also hinting at being data dependent, meaning they are ready to pivot if needed. So what's the bottom line? Will the Fed print again? Yes, if anything is broken, such as if market crack, recession looms, or systemic risk resurfaces, but this time they will do it quietly through digital mechanisms, controlled QE, and using secretive liquidity tools. Nothing bold, headline-grabbing money sprees would be used this time. But the real question isn't if they will print. The real question is, it's whether they can do it without breaking something else in the process.
Hello, Bitcoiners. Thank you very much. Hello. It's good to be with you. It's good to be with you. And Bitcoin is going to the moon, as we say. It's going to the moon.
Which takes us to risky assets like Bitcoin. Now, assuming something is broken and Fed is forced to print money, then here's how a return to Fed liquidity, also known as aka money printing, could directly impact Bitcoin across different angles. In this segment, we will look into Bitcoin as a hedge against fiat debasement. Liquidity pours into risk-on assets that triggers crypto rally. Institutional flows shift towards Bitcoin. A tailwind narrative that's building up, that is Bitcoin is an escape from the system. When the Fed ramps up liquidity, it increases the money supply, which often weakens the purchasing power of the US dollar. And that's exactly where Bitcoin shines because it has limited supply and scarcity premium. Limited supply means with only 21 million Bitcoin ever to exist, Bitcoin becomes a natural hedge against fiat currency inflation. And when it comes to scarcity premium, as the dollar gets diluted, Bitcoin's fixed supply looks more and more attractive, lucrative, tempting, juicy, especially to institutional investors and macro traders. And the result is more demand, especially from those feeling inflation risk, resulting in upward pressure on Bitcoin price. But how would liquidity pour into risk-on assets and trigger a crypto rally? When the Fed prints or loosens monetary policy, interest rates drop, credit flows more freely, and risk assets across the board, such as stock, tech, crypto, they get a boost. But why? Because in a low-yield world, investors hunt for returns, and Bitcoin has historically outperformed in these risk-on environments. Just look back at 2020 to 2021 QE. That triggered a crypto rally and Bitcoin soared from $10,000 to $60,000. And even back in 2023, when we witnessed banking stress combined with Fed backstop, Bitcoin jumped from 16,000 to over 30,000 in just a few months. Not to forget that big players like BlackRock, Fidelity, and sovereign funds are watching monetary policy quite closely. If they believe that long-term inflation is back on the horizon, they will look for uncorrelated assets with built-in scarcity such as Bitcoin. What makes Bitcoin more tempting? Bitcoin ETFs. Bitcoin ETFs now make that exposure institutionally acceptable and easy to scale. The narrative has changed. Bitcoin is no longer a magic internet money, it's a macro asset. Now, you must consider that given the backdrop of economic uncertainty and instability, if the Fed is forced to restart stimulus, especially during high inflation or rising geopolitical tension, it sends a very powerful message. The system needs artificial support to survive, and that fuels Bitcoin's original appeal, which is decentralization, non-sovereign, and its immunity to central bank manipulation. As a result of which we can expect a retail and emerging market adoption to accelerate under this narrative. But of course, it's not all upside. A sudden Fed pivot could also spike short-term volatility across all assets, leading to wild swings in Bitcoin as traders try to front-run the next move, and it could also stir regulatory responses as crypto gains more influence. Still, the macro setup would favor Bitcoin over a longer period of time over time. So what's the conclusion? Now, if Fed returns to liquidity mode, Bitcoin would benefit from inflation hedging, risk-on capital rotation, and its narrative as digital gold in a broken fiat world gets ingrained into the financial history. Bitcoin isn't just a speculative asset or a magic internet money anymore. It's a macro weapon, and it's ready to move. If the Fed prints again, liquidity floods back in, the dollar weakens, and Bitcoin, it flies. As simple as that. If you found this content informative, please subscribe to my channel for more educational videos on Bitcoin in the context of macro and micro factors. Drop me a comment and do share this video. Thanks for watching.